Over the last several months, we have witnessed through our clients, through our, just where we work and how we work, the advent of these rescue funds and, syndicators who are now finding themselves a little bit behind the eight ball, and who you've seen the banks have already started foreclosing on some deals. And, I talked to a buddy of mine, Bob Damigella, who's a Marcus Millichap Financial Services whiz bang. And I said, hey, what do you think is going to happen? He says, Charlie, it's going to be a bloodbath. There are so many loans that will be coming back to the bank. And so you're seeing a lot of people running around scared. And, what I want to have in this conversation is a real conversation about what happens to deals when the deals start going south, and what you can do to protect yourself, and also what you can do to be ready for it, to see the warning signs. And I'm going to use some anecdotal stories here to tell you, stories that happen to me, and also some students that are happening to some stories that are happening to my students right now as well. And so, David is here to join me with this conversation, because David is, he knows how to deal with lenders. He knows how to, converse with these people, and he's been warning me before I saw the warning signs of what's going on in this market. So, David, introduce yourself to all of my friends online right now.
Thanks for having me, Charlie. I always like to tackle these topics with you. I think you have interesting topics. I think you're willing to maybe go places sometimes people won't go, and what do they call it? Polite conversation.
Because I've been there before, and I live to tell about it. And I tell you something, folks. When I was going through this same crap back in 2008, my world was caving in around me, and I there I was, this great big multifamily owner operator, and things just started to cave, and I just thought, wow, my life is over. I'm going to have to go work somewhere and do something, and it was scary. I was married with four little kids. It was a scary time, but I made it through, and it made you a better person. And I think it made me a better teacher to people about what's going on. And I can't sugarcoat what happened to me. That would be doing a huge disservice to people, to make them think, oh, everything's going to be great. This is going to be fine. We'll bounce right out of this. Because I really do. I've seen the handwriting on the wall for the last couple of years, and I've told people about it. And you got to be careful how you buy these properties. And I watched some of these gurus get out there and teach their students that, you could do certain things that you really shouldn't have done, because when we did them back in 2008, we got ourselves into big trouble. One of the things that I'm talking about is rose-colored glasses in looking at the future, rent increases for properties, rose-colored glasses in, thinking that your bank is your friend and an 80% LTV is okay. A 1.2 debt coverage ratio should be fine because the bank says it's okay. So, those types of things that I learned the hard way, that's not the way to run one of these businesses. And so we're going to get into it. We get higher interest rates. We have higher cap rates. And I remember listening to some mad data scientist, give a whole presentation on how interest rates, if they go up, it doesn't mean that cap rates are going to go up, that there is no correlation between the two. And I'll tell you, if that person is listening today, he's probably thinking to himself, I didn't say that. Well, you did. But you talk so fast that in your next presentation, you said something totally different. So let's talk about how interest rates and cap rates are connected, David, even though they're not connected. So go ahead. Let me see if you're going to give the same answer I will give.
They're not directly connected, but they're correlated, and there's no way that you can break that correlation essentially as an investor, right? I think the reality is that cap rates are based on income, right? How much income you can make, and as interest rates rise, people are going to, if you can get 5% in the bank, why would you accept a return of 4% on an investment property? And the other thing is, the only reason that cap rates could keep compressing realistically was because the interest rates kept going down, so the debt service kept going down. And that was the only way, the deals could pencil basically at those kind of cap rates, was that they were getting these loans at extremely low interest rates. And I mean, it's just, you literally can't make the typical syndication structure work if the interest rate is higher than the cap rate. I mean, it doesn't work.
Right. Negative leverage.
Right.
And there are actually deals being done right now with negative leverage because they are true value add deals. And that's why the investors are doing them. But that was another problem. Talk about rose-colored glasses. Some of these people, their concept of value-added deals required the market to fix the value add, the missing value add. And you can't do that. If you're an investor, you don't rely on the market to change the valuation of your property. You get in there and you do it yourself. Now, let me pin you down, David, just so I can prove to everybody that, that what you said was right, sort of. No, it actually was right. But here's what I mean. David, what two variables determine the cap rate?
Well, the NOI and the price.
Right. Two variables. So
NOI being net operating income, right?
Right. And so how do any of those three valuations, those three values, have anything to do with the interest rate that the bank is selling you the money at?
They don't.
They have no correlation. So
however, let me chime in here. Basically, if your cap rate is lower than your interest rate, your debt service is always going to be greater than your NOI. Therefore, like you said, only if you're doing some type of a really deep value add where you're going to crank that NOI up really fast, really quickly to catch up with that debt service cost, that's the only way you can make those types of deals work.
Right. But here's the other issue, especially these people looking to do 80% LTVs, which you can't even do anymore in today's market. But if you're looking to buy a property and the cost of money has gone up, that you now no longer, the deal, like you said, doesn't pencil out. Well, there's only one way that the owner of the property is able to sell that property and get his money out, is by reducing the value of the property so that your deal eventually does pencil out. And when he does that, that's the equivalent of raising the cap rates. So even though interest rates aren't correlated to cap rates, in the event that the person needs to take on debt in order to do the deal with you, your price is going to be tied to that interest rate somehow. Now, remember, the reason why we don't, to get a true cap rate is that we don't take into consideration the bank debt. We want to know what the actual cap rate is on that property. But in these situations, when the cost of the money goes up, the price of the property has to come down in order for the seller to get his money out. So that's what we're seeing around here right now, and that's the deal.
Well, I think you see it with the time lag, right? And I think some of it is driven by the fact that, as we've talked about before, loan maturities, right? If somebody can keep going with their current loan, and they're still, maybe they've got that locked in for a little while, so they don't experience that higher cost of capital right away. But the problem is that in this industry, I mean, maybe there was a small group of people, I think, who were thinking, hey, I'll lock in this 15-year or 30-year, loan through HUD or somebody like that. But the majority of these loans are anywhere from, and especially the value adds, they could be 2 to maybe 5 years at the most, right? So as time goes on, unless we see something major happen that drives interest rates back down, as these things mature, that's when you're gonna see the impact, right? And so you've got this time lag in, the cap rates haven't immediately jumped the day that interest rates jump, right?
Yeah. Yeah. And I tell you, David, I saw a deal come across my desk the other day from one of our students, and it's an assumption. And it is got about 10 years left in the term, and it's got about, it's like a 2.5% interest rate. And man, that's a good looking deal. That might be the only way some of these deals are getting done is with an assumption scenario. All right. So one of the things you want to think about, or a couple of things you want to think about, is what do you do as an investor? And as an investor, we're talking about two types of investors here. We're talking about the actual leader of the deal, the GP. And then we're also talking about those LPs who just are, syndicating their deal. And, there are some that are actually signed up as a GP and they're being treated like an LP. And I see some people on this call who are in a similar situation. But the things you want to do ahead of time, just to make sure you're protected, is, you got to manage the cash flow on the property. We're talking to one of my students where the bank is essentially having a cash call. Banks can have cash calls too. And they're what happened in this particular case is the bank went in and this came about right after the Apple's Way foreclosures happened. Right after Robert Martinez, actually before Robert Martinez lost his $50 million deals. But the bank ended up sending in an engineer to do a physical needs assessment on the property. They came back and said they had to fund the deal to the tune of $500,000 in the next 30 days, or the bank was going to foreclose on the property. Well, guess what? They did. They ponied up. They called the bank, and they checked the bank and said, okay, now it's your move. But the problem is, about 4 of the initial investors had to, write extra checks to make it happen. And then the bank, and they did it because the physical needs assessment said, this is how much money you will need to put into this property to make these corrections. And then when they went and made the corrections, because remember, that is essentially a reimbursement contract. They have to put the money up first and then get reimbursed by the bank. Once they put the money up and they spent it on their own to fix some of these things, expecting reimbursement, the bank hasn't come through with the money. And the bank is sitting on it. And I say in my devious mind, I think the bank is just trying to shore up their balance sheet with that extra $500,000 so that when they take this property back, it's not going to be as hurtful to the bank as it could have been. And so that's what we're seeing is that some of these investors really need to have a plan with and this is the best plan you can come up with. Any plan you come up with has to have this answer. When is enough enough? When are you going to stop throwing good money after bad? I'll tell you, on one of the deals I did when we were having cash calls going back to our investors, and some put some money up and some didn't. And there was one investor that we worked with who was so smart, and he would always put up 100,000. I'll give you 100,000. Finally, when we went to him, he said, "You know what, guys? I think it's time to give this property back to the bank." And we did not want to hear that. But boy, was that guy right. And he knew we've probably been hanging on a little bit too much. There's probably a little bit too much emotion in this decision. And let's just be smart about it and just walk away. And that's what, a lot of these syndicators are going to have a hard time doing that. But I'll tell you right now, life gets better. When you have a dog of a property like some of these people do, where you just kind of walk back in, drop the keys in the bank's desk, and then you go start anew. What do you think of that, David?
I think you're spot on. I think it really depends on looking at the numbers. I mean, I'm always a numbers guy, right? But at some point, if you bought into it, let's just take an Arizona deal really quick. Bought in at a 3 cap and the market's a 6. Now you've lost 50% of your value. Do you want to chase that because you got 25% equity in?
No, cut your losses. Life is too short. Life is too short for you to have to stay in there and turn this thing around for the next 50, not 50, but, for this property to double in value. That's what it has to happen in order to get back there. It has to double in value. And David, you always talk about the historical analysis you did on cap rates. And, going back to 1880 or something like that. Tell everybody here what you witnessed when you went back and did that analysis. What was the range of cap rates for 100 years? And then how did that range compare to what we've done over the last 4 or 5 years?
Well, I mean, basically that range, the median or the middle of that range was about 8% over that period of time. And what you would see, with the economic cycles, you might see cap rates go up to 9.5% during a real rough patch, and down in the 6s, let's say, when things were really chugging along. And it never really broke
over a very, very,
very long time. Basically as far back as we could track, And the thing was that range was never breached, high side, low side. Basically, that's sort of that 8% was like a magnet. It would just kind of keep it from going too far one way or the other. But then, when we saw this extended period of the Federal Reserve at 0%, what we saw basically was like back about 2016, it broke out of that range and just kept marching down and down and down. And I mean, as I saw it, when I saw it break into the 5s, I was like, okay, below 5.5, I'm just out. I just don't trust this based on history, because I knew that at some point we were going to have a reversion to the mean. Now, a bunch of people made a lot of money because of chasing cap rates down to 3 caps and 4 caps, right? But it was a musical chairs game. Basically, if you got in and got out before things turned, you look like you look brilliant. But if you bought at the bottom and now you're going to lose everything, you look, not so smart, right? But it really was, depending upon a market that we'd never seen before, and some people were saying, well, now the debt is so much that it can never go back up, right? And, I didn't expect it to go back up as quickly as it did, as much as it did, but I knew at some point there'd be a reversion to the mean. And I mean, I don't think we're nowhere near the end of seeing the damage, right? I mean, we're just starting to see it.
Yeah. What was the lowest cap rate you saw during the last couple of years?
As far as, like recently? 2.7% on some build to rent property developments.
Yeah. Just even the build to rent. And that was some new concept. Who'd have thunk that you would build a house and then rent it out? What a great concept. Let's go pay 2.7 caps valuations on those types of deals.
Well, there's unlimited demand, right? And interest rates are never going to go up.
Yeah. Folks,
how can you have 10% increases in rent every year when people's incomes go up 3% and cap rates are 2%? I mean,
Folks, I know that David's from Minnesota, and I know you all kind of understand how Midwesterners are, but I have to put a little caveat on the last couple of sentences he just made. That was sarcasm. I've trained him very well. He was being sarcastic. He did not really mean that the demand is unlimited. He did not mean that. That was sarcasm. So, all right. Another thing that, my advice to these syndicators out there who are going to start going through hell and high water because of what's going on is you always answer your phone when an investor calls. Always. You just got to sit there and lick your wounds and take it on the chin, but always speak to your investors. Those are the people who are in this business for the long term. They're the ones that know that your investor is also one of your best partners, and you're going to need this person going forward. I told the story in the earlier conversation about how when we were going through hell and high water and we got sued by the SEC for nothing that we did. They came after one of our properties, and 35 investors in that deal went out and hired their own attorney to represent them against the SEC. And we were standing, in court with the SEC, my lawyers, SEC lawyers, and the investor's lawyer. And the investor's lawyer asked the court, Judge Wolf, if they could have an opportunity to speak to the court about their concerns about what the SEC was doing. And the judge, because they don't have standing in this courtroom, even though they're the investors, they're the reason why we're here. They lack standing in the courtroom in this particular case. And they asked the judge if we could speak. And the judge said, well, I would like to hear what you have to say, but let me ask the defendant's counsel. And my lawyer said, yes, we'd love to have them talk. And then they turned to the SEC and said, would you like to hear the investor's attorney and what he has to say? And the SEC said, no, we don't need to hear them. We know what they're going to say. And it just tells you that their motives were so warped that they weren't there for the investors' benefit. They were there for their own benefit. But the thing that was really nice is some of those investors became our very best friends. They came to my daughter's wedding, and we can still hold our head up high all these years later because of how we handled ourselves. And that is the best advice I can give. And I mentioned this to a student that I was talking to. I said, when you speak to that guru who he's involved with, let him know that some other guru gave you some good advice and that you should always answer your phone when an investor calls you. They're not going to be fun conversations, but they're going to know that you're a stand-up person. So what do you say to that, David?
I think you're spot on. You just got to be transparent. It is what it is. None of us are perfect.
Yeah, it is. I mean, we're doing the best we can. So let's talk about these bad boy provisions. And I got to tell you, these bad boy provisions are, when I first got started, these bad boy provisions were just a paragraph in a Fannie Mae note document. And so, folks, you can go online and just do a Google search for Fannie Mae multifamily note, and it will pull up the template document for a Fannie Mae multifamily note. And you can go in there and you can find the actual definition of these bad boy provisions. And back when I started, there were probably about 4 of them. I think they're up to about 8. Now, keep in mind that is a standard Fannie Mae template. So that's the base level of the document. Each Fannie Mae DUS lender can modify that. It has to be this level below, but it can be more. So if you're looking at a particular lender, you've got to go back and look at their actual document and what it says in the bad boy provisions. So, and if you're involved in this and you're afraid of it being triggered, don't go to the Fannie Mae website to download the template document. Find your document and read the bad boy provisions, because it could be different than what you see online. And every lender could be different. Every DUS lender could be different. So, typically fraud, waste, abuse, those are the types of triggers for a dust lender to trigger the bad boy provisions. Now, let me explain to you how this works before we start getting into applying it to a real life scenario. The situation is this. You need a KP. You need a GP. You need someone that can qualify in the KP side that meets the underwriter's requirements for liquidity, for net worth, and for experience. Then you've got these other people who are being told by these serial syndicators that, hey, you want to get to be like me? You should sign on the dotted line as a GP, and then you can get, you can go out and raise money. We'll give you a cut of it, and you can go off and sign on the dotted line, and then your name will appear in the rolls of Fannie Mae as a GP in someone's deal. And therefore, when you go off to do your own deal, they'll see that you've already been qualified. And wouldn't this be great? You get all this great exposure. And so you sign on the dotted line. And now you have signed jointly and severally on the note. Now, it's really interesting, and people don't seem to ask this question when they're sitting at the closing table because they're so excited to just get in on this deal. They don't realize that there's another document that you sign as a GP, and that's a personal guarantee. Now, remember, the beautiful thing about a Fannie Mae loan is it's non-recourse. Well, there's no such thing as non-recourse. It's actually partial non-recourse. It means that if the deal fails through no fault of your own, you can just drop the keys on the bank's desk and walk away. And folks, it's happened to me. And when that happened, it was about an hour-long meeting on my property where I signed the keys back over to the CMBS lender, and I no longer own that property. All the money that I had saved up and got into that, gone. But boy, we shook hands and parted friends. And that's what happens when you do everything right and the bad boy provisions don't get triggered. But if you do something wrong and the lender doesn't like what you did, they can come back and say, this is no longer a non-recourse. This is now a recourse loan. And all of you GPs are all on the hook for any loss that we take. And if we can't get it out of you, we're going to get it out of you. And if we can't get it out of you, we're going to keep going down the line until the last guy standing has paid us everything that we're looking for, because you all signed jointly and severally for that note. And that's a tough pill to swallow. And that's what happens when they trigger the bad boy provisions. You don't want to be in that scenario. Now, if you've been a GP on this deal, but you've been sitting on the sidelines just going about your daily business, and these guys have been running the property into the ground, you might have a little trouble when the bank comes knocking on your door and you find out that these guys have triggered the bad boy provisions. And what I say to you is, with all respect and love, shame on you. You should have known what you were getting yourself into when you signed on the dotted line. So what do you do now? What you should do now, my best advice to you is get yourself a lawyer that represents you, and don't rely on your group's LLC lawyer to protect you. That's not his job. Your lawyer's job is to protect you, and that's what you really should be doing. So, we're seeing this more and more. One of my students that I talked to quite a bit about a situation that he's in is very concerned about the bad boy provision being triggered. And the thing is that they actually had a cash call from the bank, the physical needs assessment. They had to put up about $500,000 more. My argument is, and the bank is not letting them have the money, to fix the problems. I say at that point, don't even think about triggering the bad boy provisions. The bad boy provisions are being on the part of the bank. The bank is the one that should be giving back that money, but they took their money and they're holding on to it. So these guys have done everything right. But, you know, they're a bank, and a bank has never seen a contract they don't think that they can rewrite. So, you know, don't look at them with rose-colored glasses and a Pollyanna attitude that everything will be fine. Don't trust the banks. Get yourself representation. But this is happening to a lot of people right now. It's actually a real question. It's a very good question. So, David, what do you think?
Well, I think everything you said is right. I think the other thing that, you know, I guess we'll talk a little bit about this as we go forward, but I mean, it's kind of late now, but generally speaking, if I'm signing something that's actually recourse day one, I'm never going to sign for something over probably 60% loan to value, just to protect my situation there. I mean, obviously you can't do anything about that if you've come to foreclosure, right? I mean, there it is what it is, right? Maybe your LTV was low, maybe it was high, but you have to just deal with what it is at that point. But I think, you know, when situations like that come up, that's where you have to do that analysis really and say, okay, you know, what should I do that will get me in a situation of least damage, right? It's loss control. So maybe at that point, it makes sense to try and do a capital call and hold the property another year or two. Maybe it makes sense to bring in, you know, a little bit of rescue capital to try to, you know, there again, you know, push the foreclosure out. I think, you know, we were also talking about, you know, what type of bank is it, right? You know, I mean, generally a lot of these recourse loans might be from smaller banks where, you know, they don't want to take that thing back either. So like you were explaining, you know, maybe you can work with the bank to restructure that debt in some way to, you know, get it, as you say, past the bank examiner, right?
Yeah, I mean, that's a very good point, is the fact that, you know, when you're sitting there looking to buy the loan from either a local bank or a CMBS DUS lender, you've really got to understand what the benefits and the costs are between these two different types of lenders. Now, and you know, we lovingly refer to the local lender as Frank's Bank, because a friend of mine is a bank president and his name is Frank. So we call it Frank's Bank. And when you deal with a Frank's Bank, they tend to be recourse loans. And that's what makes Fannie Mae look so attractive, because they're a non-recourse loan or a partial non-recourse loan. And Frank's Bank may increase have a higher interest rate than a Fannie Mae. So everybody thinks, oh, Fannie Mae, great answer. We should get one of those. And then Fannie Mae is always, or tends to always be, an 80% LTV. So you don't have to put down as much money than Frank's Bank. Frank wants 75% LTV. So for all of those reasons, people look at a DUS lender, a Fannie Mae lender, and they say, well, I want to go with those guys. But when the going gets tough, those Fannie Mae lenders, you're just a number. They are a factory. They just walk in and take your property. I'll tell you, I watched, I don't know if I should mention names, but I watched this one big guru. This guy started about the same time I did, and he's done fabulously well. And he was on my podcast, and he was telling me on his podcast how he only gets interest-only loans. I said, well, how long are the terms? It was 7 years. So you can get a 7-year interest only. This is back when they were very rare. And he goes, yes, I have a great relationship with my lenders. They like me and what have you. David, or our other mutual friend, Jillian Sidoti, sent me a video that this guy had put up on YouTube, probably for the benefit of all of his investors. And he was explaining how he couldn't make the mortgage payments on this $50 million transaction, this $50 million loan. And he's working with third-party consultant. He's working with the bank. He's, told the bank that we need to restructure the note to make it work. And I am watching this video and I'm seeing the pain in his face. And I felt that pain at one point in my life too. And I knew exactly what this guy was going through. And I knew when I watched it, he didn't know what the hell he was talking about, because none of the things that he was telling people he was going to do on the YouTube live, or it wasn't live, but YouTube video, he could do. That's not how CMBS works. Those guys will come in and take the property back and shake your hands and part friends. That's all they would do. And I'll tell you that, it reminded me of the time that, I gave a property back to the dust lender. And then I had to go meet shortly thereafter with the local Frank's Bank that I got a loan from. And I sat down with the owner of the bank, or one of the vice presidents of the bank, and I said, guys, what can we do to make this work? Because this is a great property. We've never missed a mortgage payment. We've done everything right. The cap rates have gone up. We're going to need to extend the loan, all this stuff. That guy and I sat in a diner over some French fries and some ketchup, and we solved the problem. And what had happened was, and I use this example, I use this example again because it was easy. Let's say the property was worth $1 million and we got an 80% LTV. So the collateral valued out at $800,000. Cap rates came down. It was now no longer $1 million. Now it was worth $900,000. So the loan was $800,000 over a $900,000 valuation. Now it's no longer an 80% LTV. So the bank examiner comes in and says that, hey, Mr. Local Banker, this doesn't qualify. You better fix this or get this loan off your books. So they go to me and they say, Charlie, in order for this to work, you got to come up with, $250,000. Can you do it? I said, no, I can't do that. I mean, I'm tapped. My money's all in this property. It was, well, okay, here's what we're going to do. The appraiser says the property's worth $900,000. We're going to cancel the loan with you. And then what we're going to do is we're going to rewrite that first mortgage so that it's 80% of $900,000. And we're going to show that to the bank examiner, and he's going to be happy with that. And the balance, we're going to make that a personal loan from you that the bank doesn't have to see. So it's called an AB loan. And that's what solved our problem. Now, remember what I said early on, Frank's Bank is personal recourse. So I dodged a bullet with that one. And I said, whew, wow, thank you very much. It was for 3 more years. We kept the property for another 3 years. Cap rates, you all remember 2008, 2009, took years before that valuation came back. 3 years later, the note comes due. We're still underwater. And I'm now on a personal recourse loan, and the bank wants something to happen. So the bank comes in, says, what do you want to do? I said, guys, I'm going to throw myself in the mercy of the bank. And they said, Charlie, you've been a stand-up guy. Whenever we called, you always answered your phone. Whenever we had a problem, you always worked with us to get it resolved. We like doing business with you, and we don't want to see you getting in any trouble with this personal loan guarantee that you have on here. We're going to do away with that loan and just, sell the property to somebody and break even, and that'll be fine. I got to keep my family's house. That's the risk you take. And like David said earlier, 60% LTV. I did an 80% LTV. And that was where I learned my lesson on that one. So I dodged that bullet because of what I said before. You always answer the phone when your investors call, and your bank is your biggest investor. So that's the deal when you deal with these bad boy provisions. And and then one final thing, and David, I don't think you know these people. But I had friends who were, they went through one of the gurus courses and they bought stuff and they got themselves into trouble. And then when the bank took the property back, it was a Fannie Mae loan. They triggered the bad boy provisions, and they couldn't understand it. So what have we done? Like, we haven't done anything wrong. This is terrible. You can't do this. And eventually they retracted that. But boy, did those people sweat it out when Fannie Mae came back in and said, we're going to trigger the bad boy provisions and come after you personally, because these people had wealth. They had wealth. So that's my story of the bad boy provisions, David. If you want to add to that sad song.
No, I don't know how much I can add to that. I think you pretty well covered that.
Yeah, I so appreciate your position on these things, because I've learned everything that you're teaching, but I had to learn it the hard way, which is unfortunate. But that was the story. So, all right, but that's what. Listen, this is the thing that all of you syndicators, all you people who signed on as a GP, and you've let somebody else run the business. This could come back and bite you. So my advice to you now is to wise up, step up, and make sure that you're being represented in any of those meetings with these investors. Okay. All right. Understand your relationship with your bank. David, tell the story about how you deal with your lenders on some of your hotel deals.
Well, I mean, first of all, our deals tend to be a little smaller than traditional multifamily, and they tend to be, you can't just put them in that neat little box that everybody wants to put multifamily in. So one of the things, I've discovered, and obviously, again, as I mentioned earlier, the whole thing with recourse, non-recourse, but I work with smaller regional banks. I actually search out these banks to find banks that are really interested in these projects, right? I mean, their businesses, their projects. And so it's really a business relationship. And because these banks are smaller, a lot of the times I'm dealing directly with the bank president in setting up and structuring these deals. So we are able, I mean, I don't get the kind of interest rates that you're going to get on a Fannie Freddie deal, but we have relationships, right? And I mean, I talk to these people all the time. I mean, at least, quarterly, if not, monthly even. And it is a relationship, like you said. And so when there are issues, they work and try to find out ways to solve the issues along with me, as opposed to just, like you were saying with the Fannie Freddie lenders. I mean, they're basically, it's like the only option is you pay, you put in extra money, or we take your property. That's it.
Yeah, but I mean, some of the stories you told where they would just send you a renewal letter and say, please sign here. And, that was it. And, if you had any questions, you pick up the phone, you call the bank president, you talk to him about it.
Right. Yeah, no, we have not had any issues with renewals or extensions or anything like that with the banks that we've worked with. And yeah, I did have, like you said, one situation recently. It was a relatively small loan. It wasn't, multi millions of dollars, but the bank knew that it was coming up. I knew it was going to be a reset. I mean, I was at 5% before and they raised it to 7%. And yeah, he just basically sent me an email saying, just sign these, papers, 5 pages of papers, and we'll run it out another 5 years.
Yeah, that's beautiful. That's beautiful. All right. I'm going to jump to the very last slide here because I want to get David's take on this. And this is something that is really happening right now for a lot of these syndicators. And we're hearing, I mean, my student happened to one student. We're seeing it happen to other deals. And why don't you talk about these capital calls, David? I mean, I've had to do them. I've had to make those calls. Nobody wants to do that, but at some point, you have to understand these things are businesses. Every multifamily property is a business. When a business is out of cash, it's out of business. And that's what the capital calls are there for.
Well, it really comes down to the numbers, right? And I mean, like I mentioned earlier, you have to really look at the numbers, whether you're the sponsor or whether you're the LP who's getting the capital call. You have to look and say, okay, the reality is, if we can't find a solution, we're going to lose 100% of our equity, right? But that's what we're going to lose straight up, right? So the question becomes, do we want to do a capital call to potentially preserve equity in the future, which may be the case. I think that's probably more likely the case if, you bought the thing at a 5 cap and it's at a 6.5 cap or 7 cap now, and there might be a chance in 3 years to get right side up. But on the other hand, if you bought the thing, like we were saying, at a 3 cap and it's a 5 to 6 cap now, I mean, you're just going to throw good money after bad, right? Because you're not going to recover. I mean, you have to look at where you're at on valuation. You have to look at, like you said, the condition of the property. You have to look at how it's being operated. Is it marketable? I think a lot of things have to go into it. And I mean, if you're the sponsor, you should be doing that research, for your investors. And if you're the investor, hopefully you have a sponsor who's transparent enough that you can, get your hands on that information to make an educated decision about, a capital call or rescue equity, like we mentioned, these pref equity things. But I mean, it's, every deal is unique, and it's probably about a 50-50 shot. I mean, half the deals probably, it might be worth trying to save, and the other half, you just got to let them go.
Yeah.
Rather than wasting more, putting good money after bad.
Yeah. Back during what was it? The savings and loan fiasco. I knew a friend investor who lost his property, and couldn't understand why the bank was taking it back. It was all had to do with valuation and the bank's balance sheet. But the bank took it back, and he showed up at the auction and bought it back at the auction, and he ended up making out better with it. And sometimes in these situations, you got to know when to cut your losses, because you might want to be the guy standing at the auction buying it back.
Right.
And that sometimes can happen. So don't get emotional over these things. I know it's hard not to do, but I've seen so many of these properties. Somebody said I had a good conversation with somebody on my podcast where he doesn't even go out and do the due diligence. He just doesn't. He just, he buys in big properties, and he knows he can just fix any problem with money, and he's got enough money that he can just do it. So he doesn't even go out and look at these properties. But now when you go out and do the due diligence on a unit, it takes you no time at all. You just look at it and say, okay, next. And there's nothing emotional about the buying decision. It's all just, can it be fixed? Everything can be fixed with money. It's just how much money is it going to take? Right. So, but folks, if you want more from David and me, you want to find out what we're doing now, we're looking at converting hotels to apartments. Our new goal is to convert, over the next 10 years, 100,000 hotel units into apartments, affordable apartments all over the country. I saw somebody posted something on one of my Facebook pages where he said, "Oh, this is ridiculous. Who needs to learn how to do that? There's nothing to it." That's somebody that doesn't know what it takes to convert a hotel. And we teach you all the works. And then if you want to work with us, we'll show you how to do it. As a matter of fact, we are currently under contract. After 60 some odd days, we're currently under contract with 2 hotels. Then we've got about another 4 LOIs out, all with students of ours who are doing some really interesting and fantastic things with converting hotels to apartments. And it's the best thing out there. It's so much fun. We're having a blast. Where the multifamily world has dried up with deals, the hotel to apartment business is booming, and the opportunities are outstanding. So if you want to come see us, go to H2A, the number 2, H2Aconference.com, and sign up, and would love to see you. And thank you, Vanessa. Nice to have you. And I've done most of the speaking this time. David, you have the final word.
I was wondering if you were going to give it to me or not, if you're going to just go off into the sunset. All right, I'll finish. This is a real opportunity to do good and do well. Make money and help others. Can't be better.
folks, we know real estate. We know how to do these deals. And come join us. We'd love to have you. We'd love to show you how to do it. It's going to make a huge difference in your investment world. So thanks, everybody. Thanks for coming out. Thanks for giving us your time.